47 odd points on the Nifty. We are almost at the day's highest point, 10,733. Manisha is joining in as always with a quick check on what's making news and waves as far as the commodity prices are concerned across soft commodities, hard commodities, oil. Manisha, what's top of mind?
Prashant, thank you so much for that. Well, it really has to be the metal space because that is where you have seen very sharp declines coming in. Today, we've seen non-ferrous metals actually see some support. But when you look at the ferrous metals, they have continued to decline. The second half of this year hasn't been so good. And as we approach 2018 end, we are looking at most of these metals actually turning bearish. If you look at the steel price as well, that's turned into a bearish market, 21% down from its 2018 highs. And we have seen weakening steel margins, increasing supply, and the winter curbs that China put very strongly last year and last winters has not been the case this time around. So you are looking at higher supplies, weakening demand concerns. All of that has pulled the steel prices to a 5-month lows. Iron ore prices is the other one because we are down by nearly 14% in this month, and 10% of that decline actually has come in this week itself. Iron ore prices also are trading at a 4.5-month lows, and you have seen that spillover come in for other metals where you have the nickel prices now trading at a 13-month lows. Those prices are down by 5% in this year, and that chart should actually come in on your screens on where the metal prices now stand for 2018, where you have seen a double-digit decline come in for lead, zinc and copper, and negative returns is what you are looking at in case of nickel, aluminum as well. These were the metals which hit a 4-year highs in the month of July, August. But since then, it actually has been a one-way trade, and that, of course, has been on the weaker side.
All right, Manisha, thanks very much. Appreciate you getting to us those ideas as far as the commodities are concerned. Well, it's time for that big exclusive, that big promised exclusive. Rhythm Desai is head India equity strategist at Morgan Stanley, and he's joining us from the sidelines of their 17th annual Asia Pacific Summit in Singapore. Rhythm, it's always a pleasure. Thanks very much. You know, the last time when we spoke, you essentially had told us that you were waiting from a global top-down perspective. You were waiting for your global emerging market global strategists to come out with their view for 2019. We have that view now. And the view is that in 2019, developed markets may underperform, emerging markets will continue to be sort of outperformers. Does that tie in with what you are picking up, locally, sort of bottom up? What's your sense?
So, good afternoon, everybody. So, I think growth in India is picking up. We have seen that for now several quarters. Revenue growth is putting successive highs. We are at a 4-year high on revenue growth for the quarter that just ended, and I think revenue growth is accelerating further in this quarter. Corporate margins have been all over the place for various reasons. We got a setback from demonetization, then GST, then some idiosyncratic factors in the latest quarter from oil and INR. A lot of that has also settled. So our view is that we are heading into the start of a new earnings cycle. Now, mind you, I have been saying this for a while, but it has not borne fruition. But I think now we have come to that moment where the headline earnings growth for the Nifty or the Sensex, I think will really show some robust numbers, led largely by domestic companies and corporate banks. So we should be ready for some really solid earnings growth in the coming quarters. That's really the story behind our EM call as well, which is that relative growth in emerging markets will exceed that of developed markets. Valuations in the emerging world are far more supportive than they have been in a while. And we also see the dollar having made a peak. So emerging market currencies, bonds, equities, all looking good to us. And in that context, I think India also should be doing quite well over the course of the next few months.
Okay. Rhythm, hi, good to see you in today. Wanted your thoughts in terms of the India-specific risk which would come in from elections. We're going through the state elections and then there would be general elections next year. How much of a risk would it pose to your outperformance thesis?
So elections are always a binary thing, very hard to actually judge ahead. And we know we've seen a lot of surprises in expected outcomes. So very difficult to tell in advance. It's clearly going to be a source of volatility. Had they not been around, then I think we would have had probably a very strong 2019. But given that we're going to have elections, I think what investors should expect is a fair bit of volatility, depending on how the electorate decides to vote in the next government. The key risk for the market is that we get a minority government and then I think the market gives up some of its gains. A minority government is not necessarily a risk to the economy, but does present risk to stock prices. So I think that's how I would view elections. To my mind, I think equities, being a longer duration asset class, people need to look beyond these events which generate volatility. And at these current levels, I think valuations are offering an opportunity for investors to do long-term investing. So that's what I would remain focused on.
Okay. Rhythm, I thought I'd jump in too. Primarily because I'm a little surprised by the glasses. When did they arrive?
Sorry, glasses? I don't see glasses. Maybe behind me.
Okay. No, I thought you could see clearly something because of those outsized glasses that you're sporting. I wanted to know if you're...
Oh, my glasses. Oh,
yes.
You mean my... Oh, you mean my glasses.
Yes.
Okay. Sorry, I didn't get... No. Yeah. I've been straining my eyes too much, reading a lot. Okay. So I finally got some glasses on. Yeah.
Okay.
I'm struggling to see long distance.
Okay, now that you can see long distance.
I think it's the natural... Lata, it's the natural process of aging. It's called growing older.
Okay. Doesn't affect me at all. Okay, not me and Ekta either. Okay. Anyways, Rhythm, I wanted to ask you about the problems in the debt market and the worries that some people are extrapolating it to in terms of growth for consumer goods, growth in real estate, construction. Do you think that can have a negative impact? Are you rolling back any of your EPS numbers because of that?
No, there is a temporary issue around that. I think the market is behaving quite well, actually, contrary to expectations, say, last month, when a lot of people thought there will be a lot of problems in November, but November went through smoothly. I don't think we're still out of the woods. I think the next couple of months are still, I would say, a little tentative. And I think it's an opportunity for large banks to grab share away from the non-bank financial companies, which I think is already happening. You can see credit growth posting multi-year highs, and I think that trend may persist over the next few months. So system-wide, I don't see any meaningful impact on credit growth. Idiosyncratically, in certain sectors where there was heavy risk-taking, there may be some temporary impact. The overall theme here is I think NBFCs will give up some share to large banks. And what we are saying about large banks, I think, is further supported by our view that the NPL cycle has ended. So this is quite a sweet moment for large banks. They're collecting deposits, they're collecting assets, and they're seeing the worst of the NPL behind them. So you can expect, especially the corporate banks, to report very strong earnings progression over the next few quarters. And the impact on consumption and construction, I think, will be temporary and probably over in the next couple of months.
Okay, so what you're saying is that the providers of finance will be not NBFCs but banks, but basically growth is not going to be stymied because of that.
Yeah, not to a great extent. A few basis points here and there. We have trimmed our GDP growth number by 10 basis points. So that is our view on the impact. We've taken down our earnings growth estimate by about 1 percentage point. So if you were looking for that number, then that's the number. So that's the impact in our view. It's not a very large impact in my view.
Rhythm, just to sort of go back to global growth versus local growth and earnings growth, not GDP growth. If for the last couple of years we were seeing global earnings growth, especially in the US, etc., at multi-year highs, margins have been very strong, but have failed to reflect in our numbers. I mean, Indian companies, Indian credits, right? Now, if we are heading into 2019 and we are saying that global growth, earnings growth even is going to start to come off, it's peaked off and may trail off, is there no implication to, how well earnings may pick up? Because you said, well, expect solid earnings growth going forward. Is there no correlation, or you think it's sort of overblown?
So Prashant?
Yeah.
No, there is correlation. See, there are two things about earnings, right? There's revenue growth and there's margins. So the correlation is much higher at the revenue growth level than at margins. Margins are far more idiosyncratic, far more country specific. So just to take your example forward, corporate margins in America have hit all-time highs. We represent that by share of profits in GDP, which are close to 12%. In contrast, in India, they are at all-time lows. Share of profits in GDP are at 3%. So we've seen contrasting trends between the US and India with respect to margins. But there is certainly some linkage between revenue growth And if the US economy were to slow down perceptibly next year, then it will have an impact on revenue growth everywhere in the world, including India. So there will be an impact on GDP growth. So the correlation doesn't break down at the revenue level, but it is very different at the margin level because idiosyncratic factors drive it. There is some amount of decoupling that has happened because I think India has achieved a lot on the macro front. So you can see that in the rate cycle. India has not necessarily synchronized itself with the Fed in this rate cycle. So in all likelihood, for example, the RBI may pause in this December. The Fed may continue to hike. Now, when did you last see that? Because ever since India opened its doors to foreign capital in 1993, we've been very synchronized with the Fed rate cycle. Not this time around. So there has been some breakdown because of India's own macro achievements. But the top line headline growth on revenue, I think, is pretty correlated. The margins are not.
Rhythm, there's a fear which is emerging about the real estate space in India. There could be a possible default. Tier 2, Tier 3 companies could be more impacted. Bond yields are spiking. How worried are you that we're going to see a structural slowdown within the real estate space, and that's probably going to augment going into next year?
So, as I mentioned earlier, I think some temporary slowdown is in the offing, but I don't see sustained slowdown. I think some stronger real estate companies will step in. Some projects may get sold. Some valuation opportunities emerge out of such funding issues. And I think there are some pretty good balance sheets around which are capable of taking over these projects. So yeah, some slowdown, but not a whole lot. Not in the mode of a crisis as you are trying to highlight. I don't think that's what I'm sensing. I'm sensing more of a temporary slowdown rather than a crisis.
Okay. Rhythm, actually, let me pursue that macro, Indian macro theme that you just spoke about. Actually, there is a seminal improvement, if you please, in the macros because we already saw food disinflation and now there is a severe fuel disinflation as well. So chances are that on December 5th, when the Reserve Bank meets, it will redraw its inflation curve far lower than what it had done in the previous forecast. Do you actually see, already today bond yields are much lower. Do you see yields falling off because of this inflation threat completely receding and that becoming an engine for growth?
So, Lata, actually there are multiple drivers to keep interest rates soft in the coming months. There's ample liquidity in the system that's being infused. Thanks to the NBFC problem, I think we've seen a fair bit of liquidity being infused. The currency pressure is off. The oil fall also brings more liquidity to our doorstep. As you rightly pointed out, food inflation is very depressed. So there are multiple factors that support lower interest rates, at least market level. I don't know if policy rates go lower, but I think market interest rates will likely remain soft for a while.
Okay. Well, if I may, one more question because of where you are. What are people saying about the tariff war? How much hinges on the G20 meet? And can things get very bad if there isn't a very good deal? Or are people extremely optimistic that the entire worry of 2018 that this tariff is going to be a big headache will get resolved once and for all?
I think the good news is that the parties are on the table discussing. They weren't until now. So hopefully we get some good news out of it. But those are certainly risks to markets across the world in 2019, that things actually worsen from here. So we have to keep an eye on that. Very hard to predict how this will go. But I think the good news is that we are going to have a discussion.
Fair enough. Rhythm, into 2019, what are the chances that we get that solid earnings growth finally? But because interest rates go up around the world, it doesn't really, PE multiples start to come off. So hence, even as earnings growth is going up, the PE starts to come off and hence stock prices don't really go anywhere. So you start to wonder what's happening. Earnings are starting to finally come through, but it's not showing up in prices. You think it's possible we get that kind of a scenario?
We're actually expecting the Fed to pause in the second half of next year. So we don't think interest rates are going up much more from here. Another 3 hikes, including December. And then we expect the Fed to pause. The US PE multiple has come down already. The India PE multiple, I think, reflects the fact that we are in very depressed earnings cycle. So we may go through a period where PE consolidates, but in my view, the better way of looking at valuations is to see price to book. And at 2.8 times book, India is actually at the low end of its 5-year trailing range. It's actually off averages. It's not at the low point, but I don't think the current environment warrants a low point on valuations. We've got 4 occasions when the market valuations have gone below 2.5 times, and those 4 corresponded with crises around the world. So we're not in that situation right now that valuations need to fall lower. So keep an eye on price to book. I think it's a slightly more reliable way of looking at valuations because the earnings are so depressed. So yeah, you may be right that we may go through a few months of consolidation in valuations, but overall I think if when earnings growth comes back and the market gets convinced that we are in a new earnings cycle, I think the PE multiples do not derate. They actually re-rate, and only when the market gets of the view that the earnings cycle is done, that's when the PE multiple starts derating.
Okay. Rhythm, going into next year then, which are the sectors that you would be recommending?
Yeah, so as I said, we prefer domestic sectors over global sectors. So we like the banks, especially the large corporate banks. We like industrials, we like consumer discretionary stocks. I like the auto stocks at these levels. I think they're coming at very good valuations. We don't like IT, we're underweight IT. We went underweight in September. We added to that underweight position in October. We continue to stay a little skeptical about IT. As I said, we think the dollar has peaked, so the rupee is unlikely to depreciate, so that tailwind is also gone. We're underweight pharma. We're also underweight consumer staples, where I think the valuations continue to bother us. So those are our positions for now.
Okay. Just to add to Ekta's question, where would you stand on stocks like L&T, Cummins? All of them reported very good numbers. So is that what you mean by industrials? And separately, what would the view be on metals at Morgan Stanley? Along with crude, the global metal cycle also seems to be peaking off.
Yeah, so Lata, we are underweight materials. In fact, my analyst downgraded the steel sector yesterday as well. So we've been underweight metals for a while, and we continue to prefer cement over global metals and mining. With regards to industrials, I think infrastructure owners, capital good companies, the infrastructure capex guys, all of them I think are in for a good time over the next 3-4 years. There's a lot of capex that I think is coming. It started off with government capex a few quarters ago. That's picking up pace, and I think in the course of 2019 post-elections, I think we should see a new private capex cycle as well. So industrials should do well over the course of the next several quarters.
All right, Rhythm, we're going to let you go on that note. Thank you very much for speaking with us and patiently answering all those questions. Have a good conference, Rhythm. Thanks indeed once again.
Substantial amount of optimism, both in their Nifty Sensex forecasts as well as in their earnings forecasts. There are too many discordant noises, isn't it? The government seems to be thinking that no credit flow is happening and there is problem. The RBI says that there is 16% credit growth. The equity analysts say that there's going to be very good earnings growth. You don't know whom to believe now.
I think we should, I think the numbers will speak for themselves, but that's some time away. But, that's the third quarter that we're talking about.